Hello everyone, good morning.
Good morning, ma'am.
Okay, so in the last lecture, we have done with the ratios, few ratios, right? So it was like current ratio we have done, quick ratio we have done, profitability ratio we have done, that is gross profit, how to check the gross profit ratio, net profit ratio, and for the business like operating ratio we have done, and the returns on investment we have done. Like for example, say if I want to invest in the company, how much return I'll get, that we have done. Okay, so today we have to start with the market value ratio. So market value ratio, you can see the we can check the performance of the company in terms of you can say the ratio shares price, because because we'll come to know the company performance. So how much company is earning related to that. So how much I'll get the profit in that. So you'll come to know. So next ratio is earning per share. So how much you are earning per share, that you'll come to know over this by this formula. So this is the formula that's called as net profit after tax. You have to take the company's profit, but after paying the tax, after paying the interest and after paying the tax, you have to take the net profit over here minus preference dividend, because in this company there are two types of shareholder. First is preference shareholder and second is equity shareholder. So equity shareholder are the owner of the company and preference shares holder are not the equity like owners of the company. So first you have to give the preference to them and you have to give the dividend out of your profit to them. Okay, so we have to deduct over here because this earning per share is calculating by the equity shareholders. So they will check that after earning the net profit and after paying off the tax to the government. So how much is available for them? How much available for the equity shareholder they are checking. Okay, so the formula is net profit after tax minus preference dividend, because you have to give the preference to preference shareholders and you have to pay the dividend to them. Okay, so you have to less that. So you will get a net profit over here. So you will get a net profit. So you have to divide by that numbers of equity shares, the holding by the equity shareholders. Okay, so this formula using, you will come to know the earning per share, how much earning you are getting from by the one share. For example, say we have to take the one example over here. So this is example one. Okay, before I start the example number one, we will see the second formula. It's related to that only. The earlier was earning per share. Okay, so next formula is price earning ratio. PE ratio, that is price earning ratio, that you can say that as per the market value you are how much you are earning. Okay, it will give you the numbers of rupees like paid by the 1 rupee of the company upon the annual's net income, you can see, because the higher the price earning ratio, the cost will be of equity capital of the this will be cheaper, बिकॉज मार्केट प्राइस अगर हाई रहेगा तो आपको जो इक्विटी कैपिटल जो कॉस्ट होगा वो चिपर मिलेगा. सो यू हैव टू कैलकुलेट ओवर हियर, दैट इज प्राइस पर शेयर. मतलब व्हाट इज द प्राइस एज पर मार्केट रेट, व्हाट इज द प्राइस of equity shares. You have to take this and after that you have to divide earning per share. So you will get earning per share after this after calculating this formula. So this formula is earning per share. So your formula is net profit after tax you want minus preference dividend. So you will get a net profit available for equity shareholders. Okay. You have to divide by that numbers of equity shares. The equity shares are older are holding the shares, numbers of shares. Okay. So you will get the EPS. EPS is earning per share. After calculating this, you have to calculate over here, that is price earning ratio. So you have to calculate price upon earning. PE ratio बोला है ना, that means price upon earning. Price means market price, and upon earning, that is earning per share. You how much you are earning, that is market price per share. So you can say the MPS upon EPS. You can also say that MPS is market price per share, that is MPS. EPS is earning per share. So for this formula, you can say the MPS upon EPS. We'll see the first example over here. From the following information, calculate the EPS and price earning ratio. So you have to calculate both over here. First, we'll calculate the earning per share. The formula is net profit after tax we want minus preference dividend upon number of equity shares. Okay. The next formula is price earning ratio. So price earning ratio means you can directly say that MPS upon EPS. MPS is market price, EPS upon we have calculated over here. So this is the question. In the question they have given you the net profit before tax. But what you want? You want net profit after tax. Clear? So over here you have to calculate the tax rate also. So net profit before tax, that is 10 lakh, and tax rate is given as 30%. So what you have to do is over here, you have to calculate the tax rate over here, tax amount, because we want net profit after tax. So just calculate now. The tax rate is, the net profit is how much? 10 lakh. So just calculate 30% on that only. So if you calculate 10 lakh into 30%, you will get 3 lakh. So net profit before tax, that is 10 lakh. So pay off the tax to the government. So less the tax payoff, 3 lakh. So 10 lakh minus 3 lakh, you will get a 7 lakh. Okay, clear everyone? Everyone?
Yes, ma'am.
Okay.
Yes,
So
ma'am.
your net profit before tax is 10 lakh. You have to calculate tax rate over here. So 30% on net profit before tax only. So you will get 7 lakh after deducting the tax. So 7 lakh, it's your net profit after tax. So my formula for EPS, that is net profit after tax minus preference dividend. So over here in this sum, you have to calculate the preference dividend also. So in this sum, there are 10% preference share capital. That means you can say that 10% preference shareholder are there. So you have to calculate, you have to give them dividend. So just calculate 10% on 10 lakh. How much you will get? 10 lakh of 10%, you will get 1 lakh. Okay. So in this sum, net profit after tax is 7 lakh minus preference dividend. So in this sum, preference dividend, you will get 1 lakh. How? 10 lakh multiply by 10%. So you will get 1 lakh. So in this sum, net profit after tax, that is 7 lakh minus 1 lakh as a preference dividend upon EPS, number of equity shares. Here they have given equity share capital they have given, but we don't want capital. We want numbers of shares, how much you are having. So you can identify easily. If you are having an equity share capital of rupees 10 lakh and 10 per share they have saying. Okay. So number of equity share will be 10 lakh divided by 10. You can got easily number of equity shares. So if you will do 10 lakh upon 10, so you will get 1 lakh only. So your number of equity shares you are holding by the equity shareholder, that is 1 lakh. So this formula is net profit after tax. Just will calculate it. See the solution. This was the formula, earning per share. What is the formula? Net profit after tax minus preference dividend. You will get number of equity shares. Okay. So net profit after tax we have seen. The net profit before tax was 10 lakh. We have seen that also. So here you can see net profit was 10 lakh minus 30%. So you will get 7 lakh over here. So your net profit after tax is 7 lakh. You have to calculate it, the preference dividend. So this is the preference dividend. You have to calculate. So preference dividend, how you will calculate? As I told you, preference share capital is 10 lakh. You have to calculate, you have to give the 10% as a dividend. They have not told you like to give the dividend over here, but there is a hidden adjustment you can call it. Whenever they are saying 10% debenture or 10% preference share, that means this is the hidden adjustment. You have to give that. Okay, so 10 lakh multiplied by 10%, you will get a 1 lakh only. So the after that, number of equity shares, as I told you, number of equity shares, how will you get? Equity share capital upon per share. How much per share you are like giving, that is face value you can say. So equity share capital, that is 10 lakh, per share is 10 rupees. Upon that you will get a 1 lakh. So this is the solution over here. 7 lakh your net profit after tax minus 1 lakh your preference dividend upon 1 lakh is your number of equity shares. You will get 6 per rupees 6 per share. That is EPS, earning per share. My earning per share is 6 rupees per share. Clear everyone? So this was the earning per share. In this sum, they have told you to calculate the price earning ratio. So as I told you, price earning ratio is market price per share upon EPS. You can do that is MPS upon EPS. Market price per share upon EPS. Okay, so we'll calculate that also. Price earning ratio. Whenever they called price earning ratio, you can calculate easily. Price earning per share. See, earning per share in the last ratio we have calculated. Earning per share was 6 rupees. We have calculated over here rupees 6 per share. And you can see in the question they have given you the market price per share. Last line. Market price per share. How much? 30. So as per market,
30.
you will get per share, that is 30. Okay, so just you have to calculate market price upon EPS, that is 30 divided by 6 you have got over here. Clear everyone? So this was the price earning ratio. So you will get rupees 5. Clear everyone? So we have seen the two formula today, that is earning per share and price earning ratio. This was the market value ratio. This both was the market value ratio. And we are left with the solvency ratio and activity ratio. We'll see one by one today. Okay. So next is solvency ratio, and first one is debt equity ratio. Whenever they told you to find out the debt equity ratio, you can say the how much contribution of, you can say the outsiders contribution, and the equity shares are the owners of the company. So owners contribution is how much. So in this ratio, you can easily identify the contribution of outsiders and contribution of the owners related to both. So outsiders means you can say the long-term debts. See, in this ratio, easily you can find the debt equity ratio bola hai. So debt upon equity, you can say that. So debt means outsiders money and equity means owners money. So outsiders money, you can say that. Long-term debentures, you can say, or long-term debts. Okay, borrowings, security borrowings, whatever they are you are having, you can take as a long-term debts upon shareholders fund. Shareholders fund, that means includes, see, long-term debts includes debentures, loans, okay, and shareholders funds includes equity shares plus preference shares plus reserves and surplus. Okay, long-term debts, you can say this was the borrowing contributions of outsiders and owners shares, like contribution of owners upon you have to do. And we have seen the long-term debts means debentures, long-term debentures, you can say bank loan, you can say financial institute loans, you can say. After that, upon shareholders fund, and shareholder fund means equity shares plus preference shares plus reserves and surplus. Clear everyone? Okay, we'll see the next. Next formula is proprietary ratio. Proprietary ratio, you can say that in this ratio, you can see proprietor is the owner. So how much owner is contributing to the like in the business for total asset. The owner कितना invest कर रहा है अपने business में asset के पीछे, वो आपको in this ratio you will get it. Okay. So proprietary ratio, this is equal to owner's fund, that is shareholders fund, that is owner contribution upon to total asset. Clear? So you'll come to know over here, because you can say the this ratio will show easily that is owner's fund upon total asset. How much total asset they have financed by the shareholders fund, you can say over here. And next ratio is interest coverage ratio. The interest coverage ratio, you can say it will show you the numbers of time like company interest, how much they are earning. So this formula is EBIT. EBIT is earning before interest and tax. What is your net profit, pure net profit before interest and tax? Huh? This is the earning before interest and tax. What is your net profit? Pure net profit. Because after earning the net profit, you have to pay the interest also to the shareholder, and you have to pay the interest tax to the government also. But we don't want that. We want pure net profit, that is earning. You can easily say that the profit before interest and tax, that is earning before interest and tax, in the same only. Okay, upon interest expenses. This is the formula, you have to take it over here. Okay, clear everyone? So this is three formula we have seen, that is the your solvency ratio. First is debt to equity ratio, that is outsiders contribution upon owner's contribution, you can say, that is long term debenture upon shareholders fund. Second, we have seen the proprietary ratio. Proprietary ratio, you can say the owner's fund upon total asset, that is owner's fund, that is shareholder fund upon total asset. Okay. Last, we have seen the interest coverage ratio, that is EBIT upon interest expense. EBIT, in this, you have to take the pure net profit before paying off the interest and tax amount. We'll see the one example over here. So we'll come to know everything over here. Okay, so this is the first example. From the following information, calculate the debt equity ratio and proprietary ratio. In this question, you have to calculate two things. That is debt equity ratio, that is debt upon equity, you can say. And the next is proprietary ratio. Proprietary ratio is shareholder fund, or you can say the proprietary fund upon total asset. So this is the question. Okay, this was the liability side, and the second one is asset side over here. So equity and liability, they have given you equity share capital, general reserve, 12% debenture, bank overdraft, and sundry creditor. They have given you in the liability side, and same asset side also they have given. Whatever you are required, you can take it for the formula. As I told you, for the debt equity ratio, what you want debt upon equity. Okay. So debt means long-term debenture you want. So in this sum, only one are there, that is 12% debenture. In this sum, you have to take as a long-term debts. So long-term debt is 12% debenture. So you have to take as a 5 lakh amount. Okay. And for calculating the equity, that is shareholders fund, so it includes equity share capital, preference shares capital, and reserves and surplus. So in this question, equity share capital 15 lakhs they have given you, and general reserve they have given you 6 lakh. So in this sum, you have to take as a 12% debenture as a long-term debt, 5 lakh upon equity. Equity total is 21 lakh. How much? 21 lakh. 15 plus 6, that is 21 lakh. Okay, so just you have to calculate 5 lakh upon 21 lakh. So you will get over here, that is debt equity ratio. This was a solution. See the solution over here, because the formula is debt equity ratio and the formula is long-term debts upon shareholders fund. So as I told you, long-term debts means you have to take as a long-term debentures. In this sum, only one is given long-term debentures, that is 5 lakh. So you have to take as a 5 lakh upon shareholders fund. So shareholder funds includes equity shareholders, preference shareholders, and reserve and surplus. But in this sum, only equity shareholders share capital is given and general reserve is given. That is 15 lakh plus 6 lakh. So you will get 21 lakh. So debt equity ratio is 0.238. Clear everyone? So you can take as a 0.24 also. Clear everyone?
Yes, ma'am.
Okay. So we'll see the next formula. Next formula is proprietary ratio. So here you have to take proprietary ratio. What is the formula for proprietary ratio? Equity share. See, shareholders fund upon total asset now. So if shareholder fund is how much? 21 lakh, as we have calculated over here. Equity share capital, that is 15 lakh. General reserve, that is 6 lakh. So total equity share capital, or you can say the shareholder fund, that is 21 lakh you have already have upon total asset. So take a total of asset, balance sheet total, you can say, that is 40 lakh. So just calculate 21 lakh upon 40 lakh. So you will get a amount of rupees over here. So this is the proprietary ratio is equal to shareholders fund, that upon total asset. So shareholder fund you have calculated over above ratio also. That is equity share capital plus general reserve. So you will get over here, and you have to take the total asset as a balance sheet total. Clear everyone? Okay. We'll see the next formula. Clear with this everyone? We have seen 5 formula today. That is what? Earning per share, price earning ratio, that was the market value ratio. After that, we have seen the solvency ratio, that is debt equity ratio and proprietary ratio. And last is interest coverage ratio. So we have left with three ratios, that is activity ratio. So we'll see that one by one. So in this activity ratio, there is one first activity, that is stock turnover ratio. So this is the stock turnover ratio formula. That is stock cost of goods sold upon average inventory. You have to calculate stock of goods sold. There is a two formula for cost of goods sold. You have to take the cost of the product, whatever you are selling. Before the selling, what is the cost? For example, say you can say that I am selling the 21 lakh rupees. My selling price is 21 lakh rupees, and my profit is around 1 lakh rupees, around my 1 lakh rupees. So what will your cost is? Your selling price is 21 lakh and your profit is 1 lakh. So sales minus profit, you will get your cost. So sale was 21 lakh, profit is your 1 lakh minus this, so you will get 20 lakh as a cost. So this was the first formula you can calculate as a cost of goods sold. You can do cost plus profit is equal to sales, or you can do the sales minus profit, so you will get a cost. And there is a second formula is also they have given you over here. And next is average inventory. Inventory is your stock and you have to take an average. So whenever you have to take the average, you have to divide by 2. That is opening stock plus closing stock divided by 2. So you will get an average inventory over here. Clear everyone? Stock turnover ratio formula is saying that cost of goods sold upon average inventory. So cost of goods sold, there is a two types of, like you can calculate of two types over here. That is cost plus profit is equal to sales. So the cost is the cost of goods sold. And second formula, that is opening plus purchase minus closing, you will get a cost of goods sold over here. And if average inventory, whenever you want the average, you have to divide by 2 over here, na? So opening stock plus closing stock divided by 2. So we'll see this next. So this is the cost of goods sold formula over here. You can see over here, I have told you the first type of how to calculate cost of goods sold. That is cost plus profit is equal to sales. So in this equation, there is a cost. So cost is equal to your cost of goods sold. This was the first. This is the second, like you can say, cost of goods sold. Okay. So beginning inventory, you can say as a opening inventory. You have to take a opening inventory, that is opening stock, plus purchase, that is ending inventory. You have to less over here, that you can say the closing stock. So opening stock plus purchase minus closing stock, you will get a cost of goods sold over here. Clear everyone? This is the two formula cost of for calculating the cost of goods sold. You can take any one of this as per the question, depend upon the question, what they have given you. So you can take as per the formula. Okay. So we have seen the stock and that is stock turnover ratio. Second is, so over here, that is average stock. How will you get average stock? Opening stock plus closing stock upon 2, as I told you earlier. Clear everyone this formula? Everyone?
Yes, ma'am.
Okay. So next, we'll see the example over here first, how to calculate the stock turnover ratio. So in this question, they have given you the annual sales, that is 20 lakh. Gross profit, they have given you the 20%. Opening stock, they have given you. Closing stock, they have given you. They have asked you to calculate the stock turnover ratio. Okay. For this, you have to see stock turnover ratio formula is COGS upon, that is cost of goods sold upon average stock. Okay. But for calculating the cost of goods sold, you are having the two formula. Used two equation, you can say. So which equation is applicable for this? You can see they have given you the gross profit. So first equation, it will calculate over here. See opening stock, closing stock, opening stock plus purchase minus closing stock for calculating the cost of goods sold. This equation is not applicable for this sum because they have given you the gross profit percentage. So you have, see, gross profit is, your profit is depend upon your sales. How much you are selling, that depend upon your profit also. It's depend profit also on that. So 20 lakh is your sales and you have to calculate the gross profit over here. So just calculate 20 lakh upon, that is multiply by 20%. So you will get your cost. Because say, first is your COGS. So you can see over here, that is cost plus profit is equal to your sales. So in this sum, sales is given 20 lakh. and your profit is 20%, you have to calculate on your sales. That comes to 4 lakh. Clear? So your sales is 20 lakh. You have calculated 20% profit on your sales amount. That is 20 lakh multiply by 20%, you will get 4 lakh. So you have to go the reverse. Because normally we have to do is cost plus profit is equal to sales. But in this sum, we have to calculate as a cost amount. So in this sum, you have to calculate, go the reverse. That is, when we do this cost plus profit is equal to sales, but in this sum, you have to less sales minus profit, you will get a cost. That is 16 lakh. Clear everyone?
Yes, ma'am.
Okay. So in this sum, you got the COGS. You have to calculate the average stock over here. So you can do the average stock. So average stock you can do the easily. That is opening stock is 3,85,000 plus closing stock, that is 4,15,000 upon 2. You have to do the average now. So just do that. 3,85,000 plus 4,15,000. So you will get over here 8 lakh upon 2. So you will get 4 lakh average stock. So this is the formula. Cost of goods sold 16 lakh you got by this formula. And upon average stock, that is 4 lakh. 4 lakh how much you got from 3,85,000 plus 4,15,000. So you will get 8 lakh upon 2. So you will get 4 lakh. So stock turnover ratio is 4 times. That means you can say that if you are having a 4 lakh ka stock in your godown, so you can do easily 16 lakh ka sales. Or you can say that if you are doing a 16 lakh ka sale, like so you are having a 4 lakh stock in your godown. This formula is shown by businessmen only. They businessmen, they can check this formula, calculate. Okay, clear everyone? So next is we have to calculate the activity ratio. So in the activity ratio, there is the first formula is stock turnover ratio. We have seen by the example also. So next is debtor turnover ratio and creditor turnover ratio. We have left with two, debtor turnover ratio and creditor turnover ratio. So first is debtor turnover ratio. You can call it as a account receivable turnover ratio also. The formula is credit sales upon average debtors, or you can say the account receivable. Two names are there. You can call it as a account receivable, or you can call it as a debtor. Average debtor you can call. So the stock, this is a debtor turnover formula is credit sales upon average debtor. Whenever in the question they have given you as a sales, you have to calculate credit sales, because in this sum we have to calculate how much credit we have given to the customers. You can call it as how much time I give the credit. In this sum, this form, by calculating this formula, you will get an answer in times. That you can say the I given to normally I give the credit to the customer on times. How much time I have given. Okay, so this is the formula of debtor turnover ratio. The formula is credit sales upon average debtor. So average debtor includes debtor amount plus bill receivable amount. Account receivable you can say includes debtor amount plus bill receivable amount, but we want both the average. We want average debtor, we want average bill receivable over here. So formula is credit sales upon average debtor plus average bill receivable. Clear everyone by this formula?
Yes, ma'am.
Okay. So next is debtor collection period, you can say. That is days sales outstanding, you can say. This is the name, second name, or this second name is debtor collection period. Debtor collection period. The formula you have to reverse over here. In this formula, the ratio is credit sales upon average debtor or average account receivable. But when you find out the debtor collection period, you just have to reverse the formula. So the formula is account receivable upon credit sales. But the extra is you have to multiply by 365 or 12 or 52. 365 is day in a year, 52 a week in a year, or 12, that is month in a year. Depend upon the question, आपको किससे मल्टीप्लाई करना है. अगर क्वेश्चन आपको इन टर्म्स ऑफ मंथ बात कर रहा है, तो टॉकिंग अबाउट इन द मंथ, इन द टर्म्स ऑफ मंथ, you have to multiply with 12. The question is talking about in the terms of days, so you have to multiply by 365. And the question is talking about the terms in a weeks, so you have to multiply with the 52. Clear everyone? The formula
Yes,
will
ma'am.
have to reverse it. So there is a two formula for data, like first is data turnover ratio. So data turnover ratio is credit sales upon average receivable, and average receivable is includes average of debtor amount and average of bill receivable amount. And next is debtor collection period, that is in your screen. Days sales outstanding they are saying. So you can call it as a debtor turn collection period also. The formula you have to reverse it as a average receivable upon credit sales multiply by 365 slash 12 slash 52 depend upon the question in terms of they are talking about. Clear everyone this? So we'll see the example over here. So in this example, you have to calculate the data turnover ratio and data collection period also. So they are saying the calculate the data turnover ratio and collection period in terms of month. See, you have to see the collection period in terms of month. That means here in this formula, you have to multiply with this formula, you have to multiply with 12, not 365, because they are talking about in terms of month. Clear everyone? अगर वो लोग इन टर्म्स ऑफ मंथ में बोलेंगे तो आपको 12 से मल्टीप्लाई करना है. अगर यहाँ पे बोला होता इन टर्म्स ऑफ वीक, सो यू हैव टू मल्टीप्लाई विद 52, एंड इन टर्म्स ऑफ डेज, सो यू हैव टू मल्टीप्लाई विद 365. So this is the question they have given you. Credit sales for the years, that is 60,000, average debtor 5,000, average bill receivable 5,000. In this sum they have given you the average for both. Average data also they have given you, average bill receivable also they have given you. What do you mean by average? Average means, see, average data na you want, that means you can take as a opening data plus closing data divided by 2, so you will get your average data. But in this sum they have provided you the directly as a average data. Clear everyone?
Yes.
Okay.
Yes, ma'am.
So we have to solve the, first we'll solve the data turnover ratio. The formula is credit sales upon average data. So you have to calculate, sales is given, that is 60,000, and average data and average bill receivable also they have given you 5,000. So 60,000 upon 10,000. So this is the formula. You will get a 6 times. Answer you will get a 6 times. How you got credit sales given in the question, that is 60,000. Average data you have to take as a 5,000. 5,000 you have to take a both amount, because they have given you the directly average. But sometimes it happens like opening data they have given, closing data also they have given. So we want the average now. So you have to calculate as a opening plus closing divided by 2. And whatever amount you are getting after dividing by 2, so you have to take as an average data over here. Clear? And in this sum, you have to calculate as a collection period. So you have to give the formula opposite. That is average data upon credit sales. So formula they are talking about the in terms of months. So you have to multiply by 12, because average data you are having, that is average data 5,000, average bill receivable that is 5,000. So you have to take 5,000 plus 5,000, you got 10,000 over here, and average and the credit sale they have given you the 60,000. So 10,000 upon 60,000 multiply by 12, so you get 2 months. That means you can say whenever you are doing the selling of the to the customer, you give normally 2 months credit to the customer. After selling to the data, you got after 2 months the payment of this. You can say that also. Clear everyone?
Yes.
Okay. As we have seen the debtor turnover ratio or collection period, same formula for creditor turnover ratio, or in this sum there is a collection period. For that you can say the payment period. Data turnover ratio formula will be same over here for the creditor turnover ratio, and in this sum there is a collection period. We have to calculate the payment period, because we have purchased, we have to pay. Okay. In this sum there is a data turnover ratio we have taken as a credit sales But while calculating the creditor turnover ratio, you have to take as a credit purchase. Clear? And whenever you have to take the average debtor, you have to take over here, there is average creditor. And average creditor includes creditor amount plus your bills payable amount. We'll see that. So this is the payable turnover ratio, you can say, the creditor turnover ratio. The formula is credit purchase upon average creditor. Clear? So over here you have to take as a credit purchase amount, and upon you have to do is creditor plus bill receivable total. Clear? Same we have done in the data turnover ratio. This is the payment period, you can call it as the average payment period, that you can say the creditor payment period. The formula you have to oppose it. Okay, so as the formula will be average creditor, or you can say as the average account payable, because in the data turnover ratio there was the average account receivable. So in this sum there is a payable. Okay, upon total credit purchase. And after that you have to multiply with the days, month or a week, depend upon the question they have given you. Clear?
Yes, ma'am.
Okay, we'll see the example of this. You have to calculate the creditor turnover ratio in this sum, and you have to calculate the payment period in terms. The question they have given you, credit purchase for the year, that is 10 lakh. They have given you the credit purchase directly, but in this sum, we want the average creditor. Credit purchase you got, okay? But after that, you have to credit purchase, you have to divide with the average creditor. But for calculating the average, they have given you the creditor opening and the creditor closing. So as I told you, you have to do the opening plus closing upon 2. Clear? So in this sum, the opening is 2 lakh and the closing is 1 lakh. So 2 lakh plus 1 lakh, that is 3 lakhs, and 3 lakh upon 2. So it comes to 1 lakh
1 lakh 50.
Yes, you can say that the average creditor is 1 lakh 50. Clear?
Yes.
Okay, next is bills payable opening and bills payable closing. So here also same you have to do is opening is 40,000 and closing is 60,000. So 40 plus 60, it comes to 1 lakh, and 1 lakh upon 2, it comes to 50,000.
50,000.
So here you have to multiply with this, no multiply, divide by.